towards the end of the class today, and I thank you for hanging in there with me. This is actually my favorite part of the class, and this is the bonus tip of the day, is you all have different industries that you're working in out there, and you have to ask yourself the question, well, how do I even know if my percentages are good? What percentages are good? What does it mean to have a good percentage? So in the large scheme of things, when you're talking about all businesses, a rule of thumb is that if you have 10% left over at your bottom line before taxes, you're doing pretty well. That is an industry standard of any industry. You're doing great. Then you have enough room for taxes and then paying out money to your shareholders or taking a draw. You have money left over after tax. And textbook formula, I still always go back to this one. I love this one. It has always worked for me in the multiple industries I've worked in, whether it's been retail, oil and gas, manufacturing. I know there are industry standards out there that are different really for different types of industries, but if you really don't think your business compares to an industry standard or any other business because you're unique, then I would say keep these percentages in your back pocket. These will rarely steer you wrong, and as long as you are managing things below the line, understanding that you can't squeeze out more margin for bottom line expenditures than you have in the top line to allocate towards those expenditures, the bottom line for you is always going to be good. And this right here, I'm going to show you this last thing. EBITDA is something that's well known in the circle of accountants, generally accepted accounting principles, people that use financial statements for information. EBITDA is an abbreviation, an acronym actually, and it describes your bottom line as it pertains to earnings before income, taxes, depreciation, and amortization. And I bring this up to you today because EBITDA is your top line, bottom line for operational metrics. So, top line, bottom line for operational metrics, not depreciation, not amortization, not interest expense. All of those things are a function of what you have on the balance sheet and the capitalization rate or the amortization rate per month, per year, based on your fixed assets or your assets value. You're not largely concerned about how much your depreciation expense is. Depreciation is not performance. Interest expense is not performance. Interest income is not performance-related information. It's information that belongs to the bottom line. Yes, it belongs to the bottom line, part of your P&L, but it doesn't pertain to performance. These things are static. And if you buy more equipment, your depreciation expense per month increases. If you sell some fixed assets or you start leasing assets, all of these things factor in, yes, but unless it's up here, this top line, unless it's an expenditure that pertains to the top line, meaning it drives sales, unless you're talking about something up here, it's not an operationally driven expense. It's more of a support expense. It's what your business requires to maintain ongoing operations. Yes, you have to have these things. Yes, every business advertises. They usually have mileage and auto expenses and professional services. All businesses usually have this. But the idea is to keep these things small as they can possibly be, and allow your business to run operationally fluid, meaning these things don't bottleneck your performance in any way. So at the end of the day, these are the percentages that I say are good. And when you're looking at the different sections, even your bottom line, you can divide further into more sections. These are general administrative expenses that are ongoing. And then below EBITDA are the expenses that you kind of inherit from the balance sheet. They come over as a function of balance sheet assets, and they don't, you're largely not in control of those the way you are these things. Let's say your bottom line between here and here is more than your budget, is more than your good budget target. It may be that in that month, your professional services were a lot higher than they normally are. At the end of the year, generating W-2s and closing months and preparing taxes, all of those things that are end of year expenses will hit your end of year P&L. And you have to keep in mind, if you have fluctuations that are seasonal, that's okay. You're still within your target range unless this statically changes. And so, for this to be able to increase beyond 11% and still have 13% at the bottom, it's a calculation of the top line has to be larger. So, think of your P&L in terms of sections, figure out where you are, and if you don't like where you are, try to take that information, benchmark it, watch it month over month, check out the patterns of your business, might be seasonal fluctuations, and if you spot problems, that's when you are able to take this information and either make more profitable decisions or spot the problems and take corrective measures so that you can keep your eye on the prize, which is operational margins, percentage. You'll end up with the bottom line that you want every single time. Thanks very much for joining me today. It's been my pleasure to teach today. Thank you.